In our previous video, we looked at what happens to that optimal consumption point when you change income. Now let's look at what happens when you change the relative price of one good or service to another. So here we have our indifference curves representing our preferences, how much we like apps for our phone and how much we like video games. So this time we're going to change the price of video games to see what happens. So first thing we need to do is we need to start out with our example that we've been working with. And in that example, we're assuming that our income is $300. We've set aside $300 for entertainment. And we're going to start out with the price of video games at $60 and the price of apps at $2. So we need to draw our budget line. Okay. So again, if we spend all $300 on video games, this is the example that won't die, we are buying 5 video games. If we spend all $300 on phone apps, then, and they're $2 a piece, we can get 150 of them. And when we do this, we add in our, let's try that again. Let's add in our budget line here. All right. So we've added in our budget line. We're looking for the optimal consumption point. Again, highest indifference curve that just touches the budget line. So while we could choose this combination here, we could be happier. So we actually end up with our optimal consumption point there. Okay. So what is that? Well, we found that in previous videos, and we found that the optimal consumption point, so when the price of a video game is 60, that optimal consumption point, we'll just use OCP to abbreviate, was 3 video games and 60 apps. Now the question is, what happens when we change the price of video games? So what if we take the price of video games and instead of $60, we make it $30? Okay. So we need a new budget line. And we know from our previous discussions, when you change the price of one good relative to the price of another, what happens to the budget line? Does it shift straight out? No. What happens is the slope changes. Because when we change the price of one good relative to another, what we're changing is the opportunity cost. The sacrifice when you buy one good, you're giving up more or less of the other. So let's add in our new budget line. Our income is still $300, but video games are now $30 and apps are still $2. So if we spend all $300 on video games at $30 a piece, we can now afford 10 of them, right? Because they're half price, so now we can get twice as much. And if we spend all $300 on phone apps, we're still getting, doesn't let me draw on it. We're still getting 150 phone apps. So let's add in that budget line. And let's find our new optimal consumption point. So again, we want to maximize the benefit given our costs and constraints. So the happiest we can be is when the extra value to us is equal to the extra cost. If the extra value was more, we'd keep getting more. So we're stopping when they're equal, and we see that where these points, we see that where these two lines are tangent, where the opportunity cost equals the marginal rate of substitution. We can then, let's see, at that point, let's write out the optimal consumption point. The optimal consumption point here, if we look at this, what do we have? We have 5 video games and 75 apps. Okay. Now let's look what happens if the price of video games falls even further and now the price is $20. Again, income is still $300, price of apps are still $2. So in this case, if we spend all $300 on video games and they are 20 bucks a piece, we can now get 15 of them. And if we spend all of our money on phone apps, we're still buying 150 of them. So let's add in that line. Okay. So again, we're finding the optimal consumption point, and we find that here. Right there. Okay. We could connect all of these optimal consumption points. If we do, what we've created is what is called a price consumption curve. The price consumption curve shows the combination of two goods that you are willing and able to buy as we change the price of one good relative to another. So notice we held income constant at $300. We held the price of the phone apps constant at $2. What we did is we changed the price of the video games and found those new optimal consumption points. We can actually use this information to derive the demand curve. Because when we look at demand, let's write this out. So demand is the relationship between price and the amount consumers are willing and able to buy. So what we're doing is we're deriving demand, and the first thing we've created here is what is called a demand schedule. The demand schedule is a table that shows this relationship between price and the amount that consumers are willing and able to buy. So we changed the price and we looked at what happened to the quantity demanded of video games. So we saw that when the price was 60 bucks, right, the quantity, that optimal consumption point, if I go back here, this optimal consumption point had video games at 3 video games. So you can see here on our table at a price of 63 video games. We then drop the price to 30 bucks, and we can see here that optimal consumption point was 5 video games. So we put 5 here as the quantity. So we're looking at how we change the price of video games, what happens to the amount of video games we are willing and able to buy. It depends on how willing we are to buy video games. That is the indifference curves. How much do we like video games versus an alternative like phone apps? Then we have to consider what we're able to buy. That is the budget line. And that budget line is going to be based on how much does it cost to buy video games versus buying something else like phone apps. How much money do we have? And in this case, we looked at what happens when you change the price. How does that change the amount we are willing and able to buy? So when we look at demand and this relationship between price and the amount we're willing and able to buy, we can break it down into budget lines and indifference curves that illustrate the willing and the able. We put this in a table, it's called a demand schedule. But if we graph this relationship between price and quantity, so we're going to put video game quantity on the horizontal axes, and we're going to put price on the vertical axes. This is the demand curve. It shows that as the price of video games went up, the amount of video games we were willing and able to buy went down. And that's because of a couple things. The more expensive the video games are, we can't afford as many. And we aren't willing to buy as many. That is our preference, how much we like the video games. Remember, we have to consider that marginal rate of substitution. What are you willing to give up in order to maintain your happiness. So opportunity cost was what you had to give up to afford it, and the marginal rate of substitution was what are you willing to give up to maintain your happiness. It's both those in play that cause the law of demand, which says when the price goes up, the amount we are willing and able to buy goes down. And when the price goes down, we know that we can now afford more video games and more phone apps. And since we're willing to buy video games and we can afford more video games, then as the price falls, the amount we are willing and able to buy goes up. We're going to be looking in the next couple videos at another way to look at how much an individual is willing and able to buy. So another method for deriving the demand curve. And then we'll dig in more into this law of demand and what causes this demand curve to be steep or flat, what would cause it to shift. Right now, we're looking at how we can break down our choices to figure out what we're willing to buy, what we're able to buy. How does that ultimately influence what we actually buy?